I think moving on now maybe to those banks that are still in the hospital waiting room, so to speak, and looking at the banks that are still relying on government support. I mean, we've touched a little bit on the government guaranteed bonds, but in particular banks where there is still a state stake. Are there prospects at the moment for government exits for either any particular banks, or is it simply are market conditions unsuitable for that as well at the moment? I don't know whether anyone has a view.
I think we also need to underline that it's not a one-size-fits-all in terms of the capital that is still in the banking system, and you have the ownership of straight shares, you have preference shares in some places, you have subordinated bonds that sometimes have not been repaid. You have we were discussing Spain earlier, and the setting of the FROB is also effectively capital injections. So you need to think about all those classes of capital as different tools, and the timing and the way that's going to be withdrawn, I think needs to be also thought through, thinking about those various classes. And if you think about the straight equity, in a way, I mean, there can be a timetable, but there's also the fact that any government will also be like, in some cases, like any other investor. And when you invest at 10 and the equity is currently trading at 1, well, you might stay in the capital for a little longer so that you're a bit closer to your investment level. So I think all this comes into play if you think about the timing.
The equity is just the tip of the umbrella. It's actually a small number. It's the ECB's largesse in its repo operations, which is the big area of support. I mean, we all focus on the equity because it's nice.
Taxpayers fund.
Well, yeah, but I mean, the taxpayers are bearing the risk of banking assets in a different way without equity upside. Is a way of looking at the ECB operation. There are protections in the SLS which are much, much stronger than the protections in the ECB.
It is the tip of the iceberg, but there's still a lot of iceberg above the water. I mean, if you think in the US, 90% of the government capital has been repaid. In Europe, 10% has been repaid. So yes, I mean, depending on whether it's straight equity, whether it's preferred shares, whether it's subordinated debt, or our other asset protection schemes where the government is not directly putting the money in, but is certainly holding a second loss piece, for example. I mean, that's when you look at the market capacity going forward, again, I think it's back to our earlier point that time will probably be one of the critical remedies in solving the deleveraging and the exit of states, of governments from bank capital structures.
And there's of course a very strong political argument for that, because the worst that could happen is that you, as a government, authorize or acknowledge that a given bank in which you have injected capital in one way, shape or form is good to go and should be authorized to redeem, only to find 6 months later, 9 months later, 1 year later, that you have to go back to the well, or that institution has to go back to the well. So I think there's a degree of prudence, understandable prudence, on the part of the stakeholders to make sure that if and when it happens, it's done.